Hello everyone, my name is Minisethi. I hope you all are staying healthy. Today we are going to talk about types of cost, short-run and long-run cost curves, and we will also see economies and diseconomies of scale, especially for CA foundation. First of all, we will see types of cost, accounting cost. Accounting cost, also known as explicit cost. Accounting cost is actual monetary expenses of business and recorded in its book of account. Accounting cost is actual monetary expenses of business and recorded in its book of account. For example, any explicit expenses of business like rent and salary is accounting cost. Next is economic cost. Economic cost equal to explicit cost plus implicit cost. Explicit cost is accounting cost. Implicit cost means cost of using self-owned factor. It doesn't involve actual cash payment. For example, for the purpose of business, businessman uses his own building rather than giving this building on rent. No doubt he is not making any actual cash payment, but he is losing rent which he can receive if he didn't use this building for his own business. So loss of rent is a cost. That's why this is part of our cost and called implicit cost. Next is outlay cost and opportunity cost. Outlay cost is actual cash expenditure on wages, salary, rent and interest for specific project. Opportunity cost. Opportunity cost means the loss of gain from other alternative when one alternative is chosen. With the help of one example, we will clearly understand. Suppose producer have limited resources. With his limited resources, either he can produce mobile or tablet. Suppose in order to produce mobile, he give up a production of a tablet. And opportunity cost of producing mobile is loss of income which he can earn from the sale of a tablet, but now he can't because in order to produce mobile, he give up a production of tablet. So we can say the opportunity cost means loss of gain from other alternative when one alternative is chosen. Now we will see traceable and non-traceable cost. Traceable cost, also known as direct cost, and non-traceable cost, also known as indirect cost. Direct costs are directly linked with the creation of product. For example, cost of raw material, cost of packaging. But indirect costs are not directly linked with creation of product but necessary for overall operation of business. For example, cost of rent, cost of insurance and cost of electricity. Next is incremental and sunk cost. Incremental costs are additional expense of business for producing one more unit of product. For example, total cost of producing 5 units is 100, but total cost of producing 6 units is 120. 120 minus 100 is equal to 20. This 20 rupees are additional expense of business for producing one more unit. That's why this 20 will be called incremental cost. Sunk cost is the amount of money that already been spent and we cannot recover this. For example, expenditure on market research we cannot recover. Similar, you purchased a movie ticket. For any reason, you don't go for a movie, but you cannot recover cost of a ticket. Next is historical and replacement cost. Historical cost is original price paid for asset and historical cost focuses on past purchase price. But replacement cost focuses on current price needed to acquire same asset. For example, 5 years ago, you purchased a machine at rupees 50,000. So 50,000 is your historical cost. But currently you want to replace this machine and at present price of the same machine in market is 70,000. So 70,000 will be called your replacement cost. Next is private cost and social cost. Private cost is direct cost of producer. Social cost equal to private cost plus external cost. What do you mean by external cost? External cost means cost imposed on unrelated person. For example, you are owner of factory and earning so much of profit, but your factory is cause of environmental pollution, and environmental pollution is cost for society, and this cost for society is example of external cost, and social cost equal to private cost plus external cost. Next is fixed cost and variable cost. Fixed cost remain constant regardless of production. For example, cost of rent, cost of property tax remain constant no matter how much production you are doing. Variable cost. Variable cost fluctuate with the change in level of production. For example, cost of raw material and labor. As we know, cost of raw material and labor increase as you increase output, but reduce as you reduce output. Now we are going to talk about short-run cost. Short-run cost mainly divided into three parts: total cost, average cost and marginal cost. One by one we discuss about each. Now we'll see short-run total cost. Short-run total cost is equal to TFC plus TVC. Here TC is total cost, means short-run total cost, which is equal to TFC plus TVC. TFC means total fixed cost and TVC means total variable cost. Total fixed cost remain constant regardless of output. For example, cost of rent. Total variable cost fluctuate with the change in output. For example, cost of labor, cost of raw material. First column we have output, second column we have TFC, third column we have TVC, last column we have TC. At a zero output, our TFC is 10 because TFC remain constant regardless of output. Suppose you take one building on rent but haven't start any kind of manufacturing activities, but still you have to pay rent. That's why at zero output our TFC is 10, but as output is increasing our TFC will remain constant, means your rent will remain constant. Next column we have TVC. TVC will fluctuate as change in output. Zero output, TVC is 0, but as output increasing, TVC also increasing. Initially, TVC increasing at a very slow rate because we are talking about short time period. Initially, there is proper utilization of fixed factor. That's why TVC increasing at a very slow rate initially, but after some time period, TVC increase very fast rate because of over utilization of fixed factor. When we add TFC plus TVC, it will become equal to TC. 10 plus 0 is equal to 10, 10 plus 10 is equal to 20, 10 plus 18 is equal to 28. Similar you can see for other unit. When we convert this table into diagram, we will receive this. On x-axis we have output and y-axis we have cost. This horizontal line represents our total fixed cost which remain constant regardless of output. This is our total variable cost curve and this is our total cost curve. When we add TFC plus TVC, it will become equal to TC. Here you can see TVC curve start from 0 because at 0 output TVC will remain 0, but TC curve start from here, not from 0. But why? Because TC involve TFC. That's why at a 0 output we have to bear 10 rupees TC. That's why TC don't start from 0, it starts from here. Now we are going to talk about average cost. Average cost is a per unit cost, and average cost is equal to average fixed cost plus average variable cost. Average fixed cost is fixed cost of per unit output, and we can calculate average fixed cost when we divide total fixed cost with output. First column we have output, second column we have total fixed cost, last column we have average fixed cost. When we divide total fixed cost with output, it will become equal to average fixed cost. Here you can see average fixed cost is continuously reducing, but why? Initially at a 0 output you are paying rent, that means there is so much burden of you for paying rent, but as you are increasing your output, your fixed cost is same, means your rent remain constant. Obviously, burden of rent is reducing as you are increasing output. That's why average fixed cost is continuous reducing. If we convert this table into diagram, we will receive this. On x-axis we have output, y-axis we have average fixed cost. Here you can see average fixed cost is continuous reducing, and this curve represents average fixed cost. Now we will see average variable cost. Average variable cost is a per unit variable cost, and we can calculate average variable cost when we divide total variable cost with output. First column output, second column total variable cost. When we divide total variable cost with output, it will become equal to average variable cost. Here you can see initially average variable cost is reducing, then become constant almost. After that it start increasing. But why? Because we are talking about short time period. Initially there is a fuller utilization of fixed factor. That's why we are receiving more return on our variable factor. But after some time period there is over utilization of fixed factor. That's why return on variable factor start reducing. That's why our average variable cost increase. When we convert this table into diagram, we will receive this. On x-axis we have output, y-axis we have average variable cost. This curve represents average variable cost. Initially average variable cost is reducing, then become constant. After that it start increasing. There are two methods to calculate average cost. First, AFC plus ABC equal to AC. Second, when we divide total cost with output, it will become equal to AC. We have already discussed about AFC, ABC and total cost. First column we have output, second column we have total cost. When we divide total cost with output, it will become equal to average cost. Initially our average cost reducing, then become constant. After that it start increasing. Same thing you can see in this diagram. This AC curve represent our average cost. Initially average cost reducing, then become constant. After that it start increasing because of low variable proportion. Initially there is proper utilization of fixed factor. That's why our average variable cost is reducing. Average fixed cost also reducing. Eventually our average cost also reducing. After some time period it become constant, then it start increasing because after some time period there is over utilization of fixed factor. That's why our average variable cost start increasing. Eventually average cost also start increasing. Now we are going to talk about marginal cost. Cost of producing one more unit of product will be called marginal cost. Cost of producing one more unit of product will be called marginal cost. Suppose initially total cost is 200, but after producing one more unit of product, your total cost become equal to 300. 300 minus 200 is equal to 100. This 100 is change in total cost after producing one more unit of product. That's why this 100 will be called your marginal cost, because marginal cost is cost of producing one more unit of product. First column we have output, second column we have total cost, last column we have marginal cost. Initially change in total cost after producing one more unit is 20 minus 10 is equal to 10. This 10 will be called our marginal cost, because marginal cost means change in total cost after producing one more unit of product. After producing one more unit of product, change in total cost, 28 minus 20 is equal to 8. This 8 will be called our marginal cost. After that 34 minus 28 is equal to 6. This 6 will be called our marginal cost, because marginal cost means change in total cost after producing one more unit of product. That's why we can say the marginal cost is cost of producing one more unit of product. When we convert this table into diagram, we will receive this, and this curve represent our marginal cost curve. Now we will see long run average cost curve. On x-axis we have output, on y-axis we have cost. SAC 1, 2 and 3 are short run average cost curve. LAC is long run average cost curve. E, E1, E2 are production point of a short run average cost curve. Here you can see we make a long run average cost curve by joining all production point of short run average cost curve. E1 is the optimum production point and OQ is optimum level of production. But why? Because at E1 point, longer run average cost curve touches shorter run average cost curve at its minimum point. That's why E1 is optimum production point and OQ is optimum level of output. But why E2 are not optimum level of output? Because at E point, longer run average cost curve touches short run average cost curve before its minimum point. Its minimum point is here, but it touches a short run average cost curve before its minimum point. That means we still have this much capacity, but we are not producing. That's why E is not optimum level of production point. Similar, E2 is not optimum level of production point because at E2 point, long run average cost curve touches short run average cost curve after its minimum point. Its minimum point is somewhere here, but it touches after its minimum point. That means we are this much amount of factors we are overutilizing our factor of production. That's why E2 is not optimum production point. E1 is optimum production point because at E1 point long run average cost curve touches short run average cost curve at its minimum point, and joining all production point of short run average cost curve we can make our long run average cost curve. Now we are going to talk about economies of scale. This is shape of long run average cost. Initially, our long run average cost reduce, but why? Because we are receiving economies of scale. Economies of scale are some benefit which company receive when they increase the scale of their production. That means economies of scale mainly received by large industries, companies and businesses. First of all, we will see internal economies of scale. Large firms receive technical economies of scale because they invest in modern technology. They can receive loan at lower interest rate, eventually receive financial economies of scale. A large firm can hire people with specific skill, obviously receive managerial economies of scale. A large firm can reduce their expenditure on advertisement by expanding their businesses. A large firm can receive a raw material at discount rate. Obviously, they can utilize their resources at a better way. Now we are going to talk about external economies of scale. External economies of scale means business enhancing factors found outside the company. Or we can say that as industry is expanding, then whole firm receive some benefit. Eventually, their long-term cost reduce. First is economies of concentration. As whole industry is expanding, obviously each firm will receive skilled labor, transportation and communication facilities. Economies of information. As industry is expanding, they are producing at a large scale. Obviously so many trade journals and research will occur and each firm can take benefit of this. Economies of disintegration. As industry is expanding, a firm will divide their task between expert. For example, moped industry will divide their task between expert. Those who are expert in chain will make chain. Those who are expert in pedal will make pedal. Those who are expert in tire, they will make tire. Means all these things will give benefit to firm. Eventually their long-term cost will reduce. Diseconomies of scale. Diseconomies of scale are some disadvantages which large firms receive when they increase the scale of their production. As a result, their long run average cost increase. Diseconomies also divided into two parts, internal and external. Limited availability of factor of production. If you are continue increasing demand of raw material, after some time period your local supplier will not able to fulfill your demand. Obviously then you have to import, your cost will increase. There is mismanagement. If you are continue increasing your production, increasing scale of your production or expanding your business, there is no proper coordination. Because of so many technical reasons, your average cost will start increasing after some time period. External diseconomies of scale. When industry is expanding, then whole firm receives some disadvantages. Labor becomes scarce, as a result wages increase, land becomes scarce, as a result rent increase, there is so much traffic, pollution and exploitation of natural resources also. So this is all about theory of cost. I think you got it and thank you so much for watching this video. Bye, take care.